Hey everyone, welcome to another episode of the Remote Real Estate Investor. I'm Michael Album, and today joining me again is Neal Bawa, who is the founder of Multifamily U and a big time multifamily syndicator. And Neal's going to be putting his finger on the pulse of the multifamily market and sharing with us some pretty hard hitting facts. So let's strap in and let's get into it. Neal, welcome back to the show. Thank you so much for taking the time to hang out with me. I really appreciate you coming on.
It's great to be back, Michael. Great to be back.
Thank you, Neal. So last time on our
Mhm.
prior episode, we talked a lot about the single family space and what we saw going on with the market. Today, I'd love if we could focus our conversation on multifamily, since I know that you do quite a bit in that space as well.
That's right. I live and breathe multifamily. I started with single family, like a lot of the folks that are using your platform did. But multifamily is more scalable. So we currently have about $1 billion of multifamily, 31 projects, about 4,800 units that are either in construction or in lease up or are stabilized, right? So a significant portion of them are already stabilized that we're holding, but we're also building a bunch of them and working on the construction of some of them. So what's happening today is so dramatic and so unusual. One could compare, maybe it's not as dramatic as the first 3 months of COVID, but otherwise it's pretty crazy. It's pretty dramatic. So it's a great time to talk about multifamily.
Yeah. So $1 billion, and just turning back the clock a minute, I'm curious, how long did it take you to get to that point from when you started?
So ignoring a past company where I was a partner, this particular company has basically gotten to that $1 billion since February 2018. So about 4.5 years, roughly.
Holy smoke. I was just interviewing a gentleman who's got a business who wants to scale to $1 billion over a 9 year period. So you more than cut that in half. That's incredible growth.
Well, keep in mind, I don't want to demean what we've done because we're very proud of it. But when you're purchasing multifamily, the numbers get big pretty, quickly, right? So a 100 unit multifamily today is $20 million. So you do get up there very fast. So I still consider myself to be a mid-level syndicator. There's dozens and dozens and dozens of companies that have bigger portfolios than I do. And also for reference, a $1 billion portfolio usually only equates to about 10 employees in a syndication business. Now, in my case, I have 30 employees because I have 20 of them in the Philippines, and that's helping me scale. And so I have 20 full-time employees in the Philippines in addition to those 10 people. But I think it's useful to have that frame of reference. I think that if you're setting targets in multifamily, a billion is actually not a bad target to set.
Okay, I will definitely keep that in mind as I scale my portfolio. That's really great to know. But Neal, let's transition, and I would love to get your thoughts because you are a data scientist. You have so many great analytics to kind of back up your thoughts and opinions and viewpoints. Tell us, like, what's going on in the multifamily space as we're recording this today, mid to late September.
Prices are falling and they will continue to fall. It's a bad time to buy any kind of multifamily in any market in the US. And I've never actually said that before, maybe with the exception of, first month of COVID. Um, it's currently, right now, no one should be buying anything in the United States. But here's the good news. You don't have to wait very long. The market is now adjusting very rapidly. So I think February, March of next year would be a terrific time to buy. Whether it's the 1 to 4 units that get listed on Roofstock. By the way, I currently have a triplex listed on Roofstock. Check it out. It's on Brandon Avenue in Chicago. Um, whether it's those units or it's the larger unit, we're also selling a 200 unit property at this point in time, not on Roofstock, but but we're not buying anything. I mean, we've basically told our acquisition people to be pencils down, stop looking, stop talking to brokers, stop traveling to properties, because we are halfway through a correction. And I'll explain why. Multifamily is a very different animal from single family. So let's say Michael's buying a single family property and it's next to another one that's identical to it. So there's two row houses next to it. Well, if somebody last month paid $1 million for the first one, Michael can get a loan that appraises for $1 million value for his property. He can get that easily,
Right.
regardless of what really happens in the market. He can get that. And prices take so long to fall that even if the price actually falls, Michael can use a comp from half a mile away to still get that $1 million in value. So the banks on the single family side are really trusting you to to do your, to not to overpay, right? So they're just looking at it, is there a comp that matches it? And if it does, well, let's give this guy a loan, right? And if they feel like the times are hard, they might change their LTVs from 75 to 70, and but that's pretty much as far as the single family market goes. The multifamily
Okay.
market is radically different because one multifamily property is a business. It's like you're buying a Tommy's car wash, or you're buying, you're buying a subway or a chain of subways. That's the best way to look at it. It's a business. So your underwriting really doesn't matter. It's the bank's underwriting that matters, the bank that's giving you the funding. And the moment that we start seeing interest rates go up in the market, the value of the property immediately decreases. Why? Because the bank's underwriting decreases the value of the property. Because multifamily properties are based on just two things: something known as a cap rate, which is basically the market's estimate of what the property should be worth, and then something else known as net operating income, which is basically rents minus expenses, right? Now, the
Yep.
moment and the moment your interest rates increase, and most multifamily today in the US is on floating rate debt. So what that means is, as interest rates go up, your mortgage is going up. A number called DSCR. I won't go into into detail on that, but there's a number called DSCR that basically starts to fall. So the higher your mortgage goes, the lower that number is. This means that, let's say I'm a buyer and I'm selling two multifamilies and they're right next to each other, right? So they're same number of units, same occupancy, same design. So their net operating income for both of these properties is exactly the same, like down to the last cent, right? Now, let's say
Okay.
one
Okay.
sold for $30 million, okay? And I waited a month, like 30 days, and the Fed raised interest rates by 100 bips, right? But basically 1%. The second property now is worth less. It's worth less, even though there's another property that sold 30 days ago that's identical with the same number of tenants with the same rents. It's now worth less. So multifamily is on a sliding scale, and that sliding scale is affected by interest rate hikes much sooner than single family. Obviously, single family is also affected. We've seen there's 90 markets in the US where single family prices are coming down, but they're coming down really slowly, right? Like I think the average decline in the last 6 weeks has been 2%, right? And I mean, seasonal declines are bigger than 2%. So I don't even know what to make of that 2% yet. But on the multifamily side, depending upon the market, we've seen declines of 6 to 12% in multifamily prices already. And remember, the Fed only really started raising in May of this year. That we're doing this in the middle of September, right? So in
Right.
5 months, the Feds basically raised everything. There was a tiny raise back in March, but it was so tiny that it really didn't make any difference. So in 5 months, the Fed has basically affected multifamily prices to the tune of 6 to 12%. Here's the bad news. That's not the end, because everybody, including yours truly, was thinking that when last week's inflation report came out, we would see a downward trend. And the Fed would give us some guidance that, yeah, okay, well, instead of raising by 75 bips this week, there's a Fed meeting going on this week, we're going to raise by 50, and then we'll see what happens in November. Maybe we'll raise it by 25. And we were like, okay, if that happens, great. Where the Fed funds rate is at 2.25, they raise by 50 bips this week, then they raise about 25 bips in November at 3%. We're done with the Fed funds rate. And that means that multifamily doesn't have to drop any further. Well, it sucks, but that didn't happen. Inflation didn't drop. And so now the Fed this week is definitely going to raise interest rates by 75 bips. They might even do it by 100. And that basically will spike up interest rates by 100 points immediately. And then they'll have to do 75 points in November and maybe another 50 points or 25 points in December. So, because of that bad news, we now know that we're midway through this drop in multifamily, right? So, we think that there's another 5 or 6% drop coming by February or March. Is this bad? No. If you're not, if you're not buying anything, just wait for 5 or 6 months and you get 5 or 6%, you know, benefits. What the heck is wrong about that? Because the market isn't bad. Rents haven't decreased. Rents are continuing to increase nationwide for both single family and multifamily. So this isn't like 2008 where there's 5 million empty homes. Show me empty homes. I mean, there really aren't any. The market is
You
at
know, yeah.
amazing occupancy levels. This is just one single factor, the cost of debt. So If you can in February buy a property for 5% cheaper, you will have had two advantages. Number one, the next 6 months, you're not paying for that high cost of debt, right? Number two, you would, save 5%, so your property is cheaper, so your debt's less, right? Number three, you would be within 6 months of the Fed cutting interest rates. This is the part that most people don't understand. The Federal Reserve is not trying to kill us. They're just doing their job, and their job is to control inflation, because if you don't control inflation, really bad shit happens. Really, really bad shit happens. So it's much better to control inflation, and obviously the industry that is most affected when you raise interest rates is real estate. No other industry in the US is affected as much as real estate by interest rate hikes. Here's the good news though. If you look at the last 61 years, the Fed's raised interest rates 9 times, sharp up, sharp down. So if you buy in Feb, by I think July or August, the Fed should be dropping interest rates, or at least talking about dropping interest rates. Why is that important? Mortgage rates are guesses. So single family mortgage rates and multifamily mortgage rates in the US are just guesswork, where the market tries to guess what the Fed will do next. So if the Fed starts talking about interest rate declines, the market starts to price it in, right? And when the Fed says, oh, well, we might hold, right, the market reacts. So the interest rates basically adjust even before the Fed actually does anything. Perfect example of this. In December, the Fed started talking about interest rate hikes, but didn't actually raise anything, didn't change anything until March. But in those 4 months, interest rates went up 100 basis points. They went up an entire 1% because the market was guessing what the Fed would do. So if you buy a multifamily in February, and the Fed basically starts to lower rates by June, July, and August, now you're in a better environment. And as long as your rates are floating, they may float the other way. They may float down and give you a benefit, where you start high and then you float downwards. That's why I think it makes sense to wait. I've seen a lot of my friends that have larger portfolios than me, 2 billion, 3 billion, send emails to their investors saying, we're pencils down. I mean, what that means is we're not even underwriting a property. We see 10 properties a day. Normally we underwrite 3 or 4 of them. Pencils down means you just click the delete button 10 times and you're done with your job for the day.
Wow. I have so many questions, but I guess the first one is, why are mortgage rate guesses? Why don't banks look at actual data on what the actual borrowing rate is today and not worry about forecasting, but use hindsight so it takes the guesswork out of it?
I'm not 100% sure on that. Just so you know, that's what the multifamily market does, right? So the multifamily market has 2 kinds of loans, or I should say 3 kinds of loans. One of them is the guesswork kind, where they try and guess what the Fed is going to do. The other one is one that's based on LIBOR, or now called SOFR. These are basically, and basically they're based on like treasury bonds and what those numbers are. Those loans, the moment the Fed hikes, they're going to hike this week, right? So that they have a meeting on Wednesday. They're probably going to hike it by 75 bips. Well, if I have that kind of loan, and I do at some of my properties, guess what? On Thursday, my debt is a lot more expensive.
Yeah.
75 basis points more expensive. So you can see that on the multifamily side. I have never, ever seen a single family loan do that. Every mortgage that I've seen, 30-year, 15-year, 5-year ARM, they're all guesses, forward-looking guesses on the Fed's rate. Why? I have no freaking clue.
Okay. We'll have to find someone out there that can give us a definitive answer as to why that is. But I'm also curious, Neal, you mentioned at the beginning of our conversation that in the single family space, the banks are kind of depending on us as borrowers to look at the value of the home and determine, hey, this is worth it or not, which seems very counterintuitive because the majority of multifamily investors that I know tend to be able to underwrite really, really well, oftentimes better than the bank. And so why is the banks taking the power away from a multifamily investor and really giving it to a single family owner? It seems a little bit backwards, no?
Single family is considered to be a right in the United States. And single family lending is encouraged by politicians. The overall banking system believes that even if they go a little bit over on the single family side, it's not such a bad thing. Obviously, 2007 was different because it was not a a real estate failure. It was a failure of lending standards.
Right.
You know, they were basically giving gardeners $1 million loans, right? So that's not going to end well. So obviously, I don't see any evidence of that kind of stupidity existing today. There are lending standards. They're pretty tight on those lending standards. They're not going above them. You have to be, a good buyer. But beyond that, as long as there's an appraised property that's similar, your property will appraise. I am not in favor of this. Other countries do not do this. Banks underwrite single family loans in other countries the way that we underwrite multifamily loans. But because of Americans' belief that single family is a very key part of their life, we've seen this appraisal based system for the last 30 or 40 years. And every once in a while, it blows up a bubble just like it did in 2007. So this is a conscious decision that the people that run this country have made, and it has lots and lots of good sides because it tends to overall increase the prices of single family appraisal. Somebody buys for more, your property is more, and then the next one's more, next one's more. So generally, it has a beneficial effect on the real estate market, but it also tends to create more bubbles than other countries.
Interesting. Okay, that's really good insights. So, knowing that this isn't the ideal time to buy multifamily, what should people be doing? Is this the time to get educated? Is this the time to go get capital? Is this the time, what should folks be doing right now?
Um, I think that I'll give you some ideas, right? So, and I'll give you kind of a sense of, well, what would Neal Bawa be doing, and what would maybe somebody that's newer than Neal Bawa, doesn't have a lot of multifamily should be doing. So let's just focus on that piece
Yeah.
first, right? Because what I do is really different from what you should be doing, depending upon where you are in the process. So let's say you're early in the multifamily process. You should be educating your investors that an extraordinary opportunity is going to present itself most likely in Q2 of next year. So that's April, May, June, and that opportunity is that for the first time since the Great Depression, the 2008 depression, we have an unusual thing happening, and that will be multifamily prices, not single family, but multifamily prices will be low in Q2 next year compared to, let's say, now, or especially compared to a year ago. They will be low, but the economy will not be anywhere like 2008. It'll be weak, it'll be in a recession, but this is what is known as an artificial recession. So recessions are of two kinds. They come in two flavors. Number one, a recession that is artificially created by the Fed to cool down inflation. And we're about to go into one of those recessions. Those tend to be shallow, and they don't damage the economy in the long term. They create short-term damage, and the economy tends to recover fairly quickly from those. Unemployment doesn't tend to go down too much. Go up too much, I should say.
Mm-hmm.
So we're about to go into one of those. And those are the kinds of recessions where you want to buy multifamily. Why? Because multifamily prices still decrease as interest rates go up, regardless of the strength of the underlying economy. So the underlying economy right now is amazingly strong, right? So with all the hand grenades that the Fed has thrown at us for over 5 months, they've managed to move the unemployment rate from a historic 3.5% to a historic 3.7% in 5 months. They basically haven't managed to dent the unemployment market at all. And even that 0.2% increase has largely been because of more people joining the workforce. So post-COVID, a lot of people took a year and 2 years off. A lot of those people are now returning to the workforce because they're running out of that stimulus money. And that's really what that 0.2. Otherwise, when you see, like, you might see, news about layoffs in the United States, Google it, actually look at the statistics. At any point in the economy, there's layoffs, right? But there haven't been
Of course.
more layoffs than there were 6 months ago or 12 months ago. It's just the regular layoffs that happen in a normal economy. So the economy is extraordinarily strong, and it's going to get dragged into a recession simply because the Fed's going to keep throwing hand grenades until the economy goes into a recession. But because the underlying economy will stay pretty strong during this shallow recession, you've got a one-time opportunity to buy cheap multifamily, because multifamily is just as affected in terms of price, whether the economy underlying is weak or strong, right? And you have a quick chance to come out of it and make a lot of money. you should be educating your investors, telling them about this opportunity because I haven't seen that opportunity at all since 2013.
Interesting.
That's what you should be doing. Telling every investor about this and telling them, I am not buying anything now. Well, you probably don't have the investor money to buy anything now, but what's the harm in saying it? It's still true.
Right. Right. Do you think though, Neal, that at that time, Q2 next year, that folks, sellers, owners are going to see that, hey, there is this dip in prices, and therefore I'm not going to sell because I don't want to sell at a loss. I bought 2, 3, 4, 5 years ago. I'm going to hold on to my property, and there will be an inventory shortage. Or do you not foresee that happening?
There is already an inventory shortage in multifamily. Prices have still dropped. So if you look at the inventory available to sell in the multifamily market, it's half of what we had a year ago. But multifamily is different from single family. In single family, a shortage of inventory tends to drive prices up. With multifamily, a shortage of inventory cannot drive prices up because banks are underwriting and they don't give a flying F about what the inventory is. They just care about your debt cost. And your debt cost is going up. So
Yeah.
the key thing is that the single family and multifamily markets are fundamentally different. One of them is just a business, and the business is based on its debt cost and its net operating income and nothing else, right? Whereas single family is based on demand. If there's nothing available on your street to sell, whatever appears is going to sell for more. That's not how multifamily works. So even right now, supply is pretty low. But that doesn't mean that people are able to overbid, because if they overbid, guess what happens, Michael? They can't get a loan for that amount. And now they have to raise lots of extra equity, which reduces their returns. And so a lot of them are like, this is painful. We're just going to sit back for 3 to 4 months for the market to adjust. Sellers have to understand that either they just keep their property off the marketplace, which you can't do infinitely. You can do it for some amount of time, or they will adjust their pricing as they already have. Remember, we've already seen a 6 to 12% delta in just 6 months. That's how quickly multifamily reacts. And I think that's why I'm in the multifamily business, because I like the logic of that. If your
Hmm.
costs are increasing and your profits are decreasing, you should get a lower price,
It's
right?
pretty black and white. Yeah.
Yes, and that's how it works in multifamily. With single family, you can very often see costs increasing, but because everyone's holding off, nobody's basically selling their property. Everyone's like, I've got lots of equity in the property. Now there's no property in the marketplace, and even with costs increasing, you can often see increase in pricing. To me, that has no logic, and so I don't play in that field.
Yeah. Yeah. No, it makes total sense. Neal, let's talk about multifamily loan products and some of the different ones that are out there. You mentioned there's three different loan types. There's the fixed for 5, 7, 10 years.
Mhm.
There's the LIBOR, floating rate. What's the third one?
So the second one is tied to. So I'll go back, right? So the first one's straightforward, fixed. Usually it's 5 years and 10 years fixed. The second one is tied to a number called LIBOR, or LIBOR, or SOFR. These days it's called SOFR. That's kind of the new version of LIBOR. So it's a number, and the loans will be, LIBOR plus something, LIBOR plus two,
Some
LIBOR plus
spread.
2.25, right?
Yeah.
And what that means is the moment the Fed changes interest rates, that's going to change, right? So
Right.
the interest rate you're paying changes the very next day, right? Your bank's going to send you a letter saying, "Hey, SOFR has changed, therefore your interest rate is now X," right?
Hmm.
And boom, you're paying more. The third one is available, that is basically a rate that it's a floating rate, right? But it's not tied to LIBOR. It's not tied to SOFR. It's speculative in some sort of ways. Now, it does tend to go up as interest rates go up. It's really tied to treasuries. Now, US treasury bonds are a speculative product, right? So today, something happens in China, or something happens in Russia, something happens in Ukraine, and all of a sudden, treasury bonds will shoot up or shoot down. And so that particular rate is tied to the treasury bond, so it's speculative. And so, Fannie Mae and Freddie Mac offer these floating rates. Now, in the end, the rate is going to end up more or less where the SOFR one is, but it's not immediate. It's not like you don't get that happening the next day after the Fed raises interest rates. And I'll tell you why. Because it's tied to treasuries, and treasuries move upwards or downwards because of 100 different factors. Only one of those are interest rates. So geopolitical situations can often make treasuries move downwards. For example, if the Chinese economy collapses tomorrow and there's blood on the street, treasuries will go downwards even if the Fed continues to raise interest rates. Does that make sense?
Hmm.
So these sort of things, these movements can happen so that rates that are tied to the US Treasury bonds tend to move up and down with Treasury bonds. So those are the three kinds.
Okay. And who is, do you think, well suited or conversely not well suited for each type of loan?
So in terms of who is the lender?
No, if I'm a buyer and I'm going to go
What the
buy
buyer, the
multifamily,
borrower.
yeah, and I'm trying to
I
think,
think,
yeah,
yeah, so there's also something known as a bridge rate, bridge loans, which no one is getting. I don't know of a single person that's gotten a bridge loan in the last 30 days because they're simply very high. They're at 7% or even higher in the last, 30 days. So the vast majority of people today that should be buying, let's say you have to buy for whatever reason, you're not stopping, you want to buy. The key advice is everyone should get a floating rate loan because if you believe, like I do, that the Fed's job is to raise rates and then drop them, and that's what they've done 9 times in the last 61 years, then you have to believe at some point in the future, 6, 12, 18, 24 months, rates will be lower. Because right now they're pretty darn high, right? So if you believe that, locking in your rates doesn't make sense. So the market today, all we have is really Fannie, Freddie floating lanes rates, which are similar to what your local bank would provide. So maybe you have a smaller project, you want to go with a local bank. Those are the same kinds of rates that Fannie Freddie provides. They're probably charging you a quarter point more, but you've got a relationship with them. Their points are lower. So lots of people go with local banks. But I think that's the only game in the market for multifamily today. And the other thing that's happening in the multifamily market, which is driving prices down, is with multifamily, you might in a really boom time environment, you could get loans that are 75% loan to value, right? And then when the market starts to tighten up, they go to 70.
hmm,
Well, a few weeks ago, most lenders went to 65. So they're giving you a lot less loan to value for the same property, forcing you to raise more equity. When you raise more equity, your returns go down, your underwriting suffers. So once again, people are like, it's not working. I'm not going to make any money. My investors have something known as pref or preferential treatment. So if the property underperforms, they're going to make their pref. I'm going to make nothing. So a lot of people are stepping back, pencils down.
yeah, yeah, that makes total sense. That makes total
Right.
sense.
And none of this has anything to do with a crash. The 2008 scenario, if you believe that that is going to occur in the next 12 months, you're not data driven because the 2008 scenario, if you look at if you list the top 10 factors that caused it, because it wasn't any one thing,
Right.
none of those factors, not one of those factors exist today, right? What we do have is we pulled demand forward in 2021. In 2021, we basically helicoptered $10 trillion worldwide, not 10 trillion in the US, luckily, 4 trillion in the US, but 10 trillion worldwide. We helicoptered money to people for the first time in modern history. We've done a little bit of it before in 2009, but remember, we were bailing out banks. We were bailing out General Motors. The money wasn't going directly into people's pockets, right? So here we helicoptered $10 trillion worldwide, and there's an inflationary effect. It pulled demand forward. Everyone all of a sudden had money. Everyone spent money. And so we pulled demand forward from, let's say, 2023, next year, to 2021. And when we did that, we ended up creating massive amounts of inflation. Nothing to do with the economy itself, but it created massive inflation. And now we have no choice but to deal with it. I can tell you this. Um, if on the one side you said, will you take 7% single family interest rates, right, over the Fed stopping, their program now, just have them stop it. I would say don't do that. Hyperinflation is so insanely dangerous and so insanely destructive that I would, even though it would really, really hurt me, I would take 7% interest rates any day. I would take 8%, but I wouldn't tell the Fed to stop doing what they're doing. 9% inflation, if it gets entrenched, if everyone believes that 2 years from now we're going to be at 9%, it's astonishingly destructive.
Wow. 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 Okay. And Neal, I'm just curious. In based on your research, the 9 times over the last 61 years the Fed has raised rates and then pretty succinctly thereafter dropped them. How far do you think we're going to get? How low do you think interest rates are going to go? I want the Neal Bawa prediction, the crystal ball, if you will.
The federal funds rate, right? The Fed funds rate is what the Fed raises. They don't raise or lower mortgage rates. It's currently at
Right.
2.25%, and in 2 days, it's going to go to 3%. We believe currently that the peak is going to be either 3.5 or 3.75% for the Fed funds rate.
Okay.
And we think that on the downward path, they'll cut it all the way down to 1.75%. So from their peak, they'll go down 2%. So from the peak, whatever that peak interest rate is, it should go down 2%, right? Now, sometimes they have to go past that 1.75 on the downward leg because they've hurt the economy so much when they were raising rates that they have to compensate. But we think that the perfect equilibrium rate for the Fed is around 1.75. Now, in their in the public they talk about it being 2.25. That's where they would like equilibrium to be. But they never seem to ever achieve that. It's always lower than that in a normal market. So they just like to talk it up a little bit to set expectations. So we think that whatever that top interest rate is that you're going to see the highest interest rate, the mortgage rate, once the Fed is done and brings it down, you should see mortgage rates 2% lower. So there's a possibility that sometime in the next 180 days, you'll see a 7% mortgage rate, right? So it might touch that number, but I don't think it goes further beyond that.
Okay.
But who
And
knows?
then you
I could be completely wrong because if the Fed doesn't kill inflation, then all bets are off.
right. Right. Yeah. Yeah. This is all under the guise of inflation getting tampered back because of the moves. And so just to kind of put that in perspective for people as the end users, 2% reduction of the Fed funds rate will typically constitute a 2% drop on what a borrower is going to pay. So if rates get up to
Yep.
7% and then Fed funds pull back by 2%, we would expect mortgage rates to hover around that 5% in the consumer market.
Yes. Yeah, exactly. 4.5 to 5.5, going up and down a little bit. You remember it's speculative, but you'll have plenty of opportunities to, lock something in under 5%. So I think the key message is this: never be afraid of 5%. It's really beyond 5% that the single family economy starts to, um, it starts to miss heartbeats. That's where it starts to be problematic. Until 5, I've really not seen much of an impact in the marketplace. There'll be a little slowdown in price increases, and right now a slowdown is healthy. They've gone up way too much, way too fast, and
Yeah.
so a retrenchment is a very healthy thing.
Yeah. Okay. And just for frame of reference for folks, during COVID, the Fed funds rate was zero, right? They dropped it.
It was zero, correct. So we've gone from 0 to 2.25 in 5.5 months, right? And they were threatening to do it for about 4 months before that, but they wanted the market to adjust before they actually raised the rate. So we've gone up to 2.25. It was zero for 2 consecutive years. So 2 years and 2 months, the Fed funds rate was zero.
And has that ever happened in American history that you know of?
No, I
No.
think the pandemic is very unique. We saw the Fed funds rate fall to about 1% in 2009, 2010, but they didn't take it down to zero. So the only time we've ever taken it to zero is this time. I expect all future crises will go beyond zero. Now that the Eurozone has gone negative and Japan's gone negative, there's no stigma attached to going negative. So I think the next crisis will go below zero.
Wow. And that'll be an interesting time to have a loan tied to LIBOR or SOFR.
It's fantastically interesting. I think what we are Michael, we're living in the middle of the greatest financial experiment in history. And it's an experiment that has no precedent. It doesn't have anything that you can look back to, right? We're doing some truly crazy stuff, and we're hoping that it will work out, even
Right.
though
Fingers
we have
crossed.
about 3 years, we have 3,000 years of monetary history that says it's never worked out for anyone in the past. So we're just hoping that we are different. So
Right.
it's all about, as long as the musical chairs are going, people are walking, and that's how it's going to be. And I don't know when the real challenges happen. I think we're getting closer and closer. I feel like China is just about ready to combust at this point. We'll see what happens.
Okay, well, I will definitely stay tuned. Neal, this was amazing as always. For people that want to pick your brain more, continue the conversation, learn more about you, where's the best place for them to do that?
You can connect with me simply by typing in my name. I'm the only Neal Bawa on the World Wide Web, so just Neal Bawa. Hit enter. There's a couple hundred podcasts that I've appeared on. There's webinars, conference recordings where I'm on stage. If you'd like to chat with me on LinkedIn, once again, I'm the only Neal Bawa on LinkedIn, so go ahead and connect with me there, or go to my website, multifamilyu.com. So that's multifamily followed by the letter u.com. There's about 30,000 people that attend the webinars that are on that site. We have a new one coming up, which is the impact of interest rates on the economy and the upcoming recession. So real estate at this point is officially in a recession. The housing market is now in a recession because it's declining. But I think the rest of the economy is going to follow it. And so we have a webinar on that. And I think that's going to be in 3 weeks.
Okay, fantastic. Well, Neal, thank you again. Really a pleasure to chat with you and have you on. And I'm sure we'll stay in touch.
Awesome. Thanks for having me on.
You got to take care. All right, everyone, that was our episode. A big thank you to Neal for coming on. Love his data-driven approach to his conclusions, which I think we probably all could use another dose of. So as always, if you enjoyed the episode, feel free to leave us a rating or a review wherever it is you get your podcasts, and we look forward to seeing you on the next one. Happy investing.